Welcome back, everyone, to the second session of the day. It brings us to one of the most pressing topics in global insurance: how to build resilience in an era where risks are increasingly interconnected, from climate change and geopolitical tension to shifting economic forces. Moderating this critical discussion is Mr. Gamal Sak, the Regional Director for Northeast Africa and Middle East and Africa Reinsurance Corporation, Africa Re, the main sponsor of Sharm Rendezvous. Welcome him on stage. And he's joined by a panel of esteemed speakers, Mr. Moamin Elwan, Associate, Clyde & Co. I do wish you a fruitful discussion.
Yeah, I would prefer to take it while seated, make it more informal. So first, I would like to thank everyone, the speakers, for their valuable insights today. I will try to wrap up the most important emergent risks that are, in my view, the top 3 emergent risks. And those are AI, and sorry if I'm a bit boring, like it was addressed in the previous panel, but one of the most important risks now. And the other is climate change. And then the third one is the war, sanctions, and tariffs. So AI has become one of the most urgent and complex risks for insurers in the Middle East. According to one of the studies, 57% of the chief audit executives, they find that the AI is one of the top 5 emerging risks in the Middle East. While the AI now systems are emerging, those autonomous decisions can cause some financial damage. And beyond the financial damage, it can cause physical losses as well. Think about the case of Microsoft. I'm not sure, but some of you might have heard like the delays that were caused by Microsoft recently in some of the airports. It was a simple glitch that caused more than 7,000 delays in one of the airports. This can be interconnected because you have an insured party, which could be Microsoft, and then you have an insured party, which was the aircraft carrier, and you have the airport as well. Think also about the autonomous driving vehicles. So you have your own Tesla, you are going to work in the morning, suddenly someone jumped in front of you out of nowhere, you hit him, but you were driving the car autonomously. So it was the autonomous driving system. So you could be held liable because you are the person responsible for the car at the end. The manufacturer could be held liable, and the developer of the AI system could be held liable. So how the insurance industry is responding? Some of the insurance sector decided, like there are 2 approaches. One of them decided to take advantage of this. And this could be by adding an additional risk for AI risks. We have seen one of the Lloyd's underwriters that has introduced a specifically written AI policy that covers liability for AI errors or hallucinations and all of these. And you have some of the tech giants, Google, I think it partnered with Paisley, Munich Re, and other reinsurers to ensure a policy for the AI errors. On the other hand, you have to tighten your policies. So if you're not getting a premium for it, then you have to tighten your policy. And this should be through very clear, strict exclusions on AI. And I think some of you might have seen in the news one of the cases that was on social media and LinkedIn was simply a lawyer who has used AI and then quoted a court judgment, and that court judgment doesn't exist. And that lawyer was eventually fined by a court. So if you are silent on whether AI is excluded or not, you are silently covering AI or some unpredictable risk. And basically what has happened is like you can find the lawyer being fined, losing the case before citing one of the wrong cases, and then the client, because he lost the case, has going after the lawyer and getting indemnity because the lawyer is liable, and then the lawyer would go back for his insurers under PI policy to claim the amount. And then the insurers will be covering it because the policy is silent on it. So in some, it's either you take advantage of AI by offering coverage for AI or try to tighten the policy. And this is how underwriters should be working together with legal professionals on specific wording on how to cover or exclude AI. And then if we move to the second risk, climate change. This is a picture of the floods in Sudan, by the way. So climate change, the risk is not an environmental issue anymore only. It's causing a lot of it's causing a lot of physical damage in the Middle East. And within 3 years, it will probably jump from the 15th place to the 5th place of the most complex and urgent risk in the next 3 years. And it's not only about the physical or the property or risk policies coverage, because a lot of policies can interact within a single incident related to climate change. In one of the cases that we are working on, one of the showrooms in the UAE was flooded. And in that showroom, it had like several cars like Bugattis, Ferraris, and they're like numbered 1 of 10, 1 of 20, and all of kind of these things. And some of those cars are not even owned by the showroom. So you have 3 different policies interacting. So you have the property or risk policy, and then you have the business interruption because the showroom had to shut down for a few days. And then you have a motor insurance for the owners of those cars. And then you have to go around and see who's covering it. So all of this has to be done through tightening of the policy wording. And not only that, like in the Middle East, there are like ESG regulations now and reporting that's being introduced. And under those ESG, you have to do certain reportings to avoid greenwashing and all of these things. But the problem is like those ESG regulations can in the future trigger some, for example, D&O liability. Because if there are any misstatement, this can trigger the liability of the management. But the problem is like with climate change, it's very unpredictable because what can be considered a flood could be a climate change. What's like heavy rain could be climate change, earthquake can be related back to climate change. So it's very unpredictable, and I think in the future, there should be certain more guidelines on what's meant by climate change. And then if we move to the third risk, and this is war, sanctions, and tariffs. And I did intentionally put them together in the same slide or on the same topic or the third risk, because I see it very interconnected. So sanctions is a tool of war now. So you have like the sanctions imposed on Russia is because of war, and the sanctions imposed on North Korea is a tool of war. And then you have the tariffs as well. The tariffs is also being used as a tool of war. More recently, for example, Trump imposed tariffs on India for buying oil from Russia. And that was the reason for the tariffs. And then I will try to address each of them separately. So if you take tariff and how it can cause some trigger in certain risks. On the Liberation Day, out of nowhere, Trump decided to impose 10 to 50% tariffs on certain countries, or almost every country. On the same day, an exporter suddenly found that his products are subject to 50%, 40%, or 10% tariffs. This can cause disruptions in the supply chain because the buyer can default in payment, and then what will happen eventually is the seller, or the insured, will be claiming under this policy for the extended non-performance or frustration of the contract because the value of the contract or the amount that has to be paid had grew considerably. And not only about trade credits. So if you move to political risk as well, which is interconnected to trade credit, you have certain policies that has already provisions on coverage for the government acts, which might include sanctions as well. So with all these emerging risks, the reinsurers have to considerably draft their policies to avoid any silent coverage. And then beyond tariffs, the Middle East is facing like war and conflict that already prevalent. So as Mr. Marcus was discussing me, as Mr. Lars was discussing me this morning, he was speaking about the increase in premium for the insurance and all of these things. But this is the classical war risk. But there is also another type of risk that's interconnected with cyber risk. So the war is not limited to the classical war where two countries are fighting together like tanks or armies and all of these things. There is a cyber aspect. So you find cyber attacks which are related to the war itself being made. So in the recent war with Iran, you will find a lot of systems down and banks.
The time, yes.
2 minutes?
Time. The best 1 minute.
Yeah. So that's why the policies themselves should be defined clearly and drew like some sort of a line between what's considered war and what's considered a cyber risk. And then if you move to sanctions as well, sanctions is an issue not only in the insured person, but in the payments as well. So in one of the cases that we had, one of the American companies was insuring the person, and that person happened to be linked to Iran. And then the coverage was triggered under the policy, and then there was a problem on whether they have to pay or not. So the sanctions clause is an important aspect to avoid paying any money to any sanctioned entity, to avoid any repercussions from the authorities. Thank you.